Your biggest financial mistake isn't obvious, it's something you do every single month. Because most people pay everyone else first, and save whatever's left, which is usually nothing.
All right, today we are diving deep into a really powerful and honestly, often unseen force in the markets. We're talking about the liquidity sweep. We're going to break down exactly how the big players operate, and more importantly, how you can start to see the market through their eyes.
I mean, how many times has this happened to you? I bought the stock, it went down. I sold it, and it went up. It is one of the most frustrating feelings for any trader, right? You think you've made the perfect call, you put your money down, and then bam. The market seems to move with the sole purpose of taking you out. It's a feeling of regret that, let's be honest, we've all been there.
So what gives? Is it just terrible luck? Are you cursed? Or is there something a little more calculated going on behind the scenes? Well, in this explainer, we are going to pull back that curtain, and I promise you, the answer might just change the way you look at a price chart. Forever.
Okay, so to really get what's happening here, you first have to understand the two main players in this game. Think of it like a classic David versus Goliath story, but, played out on your trading screen.
So, on one side, you've got us, the retail traders. Our goal? Maybe buy 100 shares of something. And our biggest challenge? Usually is just managing our own emotions, right? That constant battle with fear and greed. But on the other side, you have the institutional investors, the quote-unquote smart money. Their goal isn't to buy 100 shares, it's to buy 1,000,000 shares. And their challenge? It's a whole different ballgame. It's not about emotion, it's almost a problem of physics. I mean, seriously, how do you buy 1,000,000 of something when there just aren't enough people selling it?
And that simple question right there, that brings us to their core motive. See, these institutions are on a constant, relentless hunt for one critical resource. And here's the kicker. It's a resource that our orders provide. And that resource is liquidity. Just think of it like the fuel for the market's engine. For you or me to buy 100 shares, it's pretty simple. We just need to find one person, somewhere out there, who's willing to sell 100 shares. Easy enough. But for an institution to buy 1,000,000 shares, whoa, they need a massive, massive pool of sellers. Because if they don't have that, their own buying pressure would just shoot the price to the moon before they could even get their full order in.
And this is the absolute key point right here. In its natural day-to-day state, the market often just doesn't have enough liquidity for these giants to operate. So if they want to buy big, they can't just sit around and wait for sellers to show up. They have to actively engineer a situation that creates a whole flood of them. So the big question is, how on earth do they do that? Well, they use a very specific and very repeatable tactic that's designed to tap into the predictable behavior of retail traders. Let's break down the anatomy of a liquidity sweep.
Okay, so what is a liquidity sweep? You might also hear it called a liquidity grab. It's basically an engineered price move. Its one and only purpose is to ram the price into areas where a ton of stop-loss orders are all clustered together. Why? Because triggering all those stops at once creates the exact burst of selling or buying that the institution needs to fill its huge position.
This right here, this is the entire playbook. Let's walk through it together. So, step one, we retail traders, we spot what looks like a really solid floor, a support level, and we start buying. And of course, where do we put our stop losses? Predictably, right underneath that support level. Step two, the institutions, they see this. They see that big cluster of stop losses like a target. They use their massive capital to deliberately push the price down right through that support. And then step three, snap. The trap is sprung. All of our stop losses get triggered, creating this huge automatic flood of sell orders. Step four, this is the magic moment for them. As all of us are being forced to sell, they are on the other side, just quietly absorbing every single share, filling up their gigantic buy order at a great price. And finally, step five, the second their order is full, all that artificial selling pressure just vanishes. And what happens? The price snaps back up, often violently, leaving everyone who just got stopped out in the dust.
Now, I know what you might be thinking. This sounds kind of like a conspiracy theory, right? But I promise you, this happens every single day. So let's look at a real-world example. We'll pull up a chart of Worry Energies and see this exact playbook in action.
Okay, so let's set the scene. You've got this super obvious support zone on the chart. The price has bounced off it not once, not twice, but multiple times. So naturally, it's attracting a lot of retail buyers. And where is everyone putting their stop loss? Come on, you know the answer. And a nice, tight, predictable little cluster right below that support line. And to an institution, that cluster isn't just a bunch of orders. It's a giant pool of liquidity just sitting there, waiting to be tapped.
And then this happens. You get this one single massive candle that just plunges right below that support level. Now, to the untrained eye, this looks like a total disaster, a major breakdown. But it's not a real shift in the trend. This is the engineered move we were talking about. Its only job is to hit those stops, force everyone to sell their shares, and guess who's on the other side, happily buying them all up? Yep, the institution.
And watch what happens almost immediately after those stops are triggered and the institution's order is filled. The price doesn't just recover, it aggressively reverses and rockets higher. So now anyone who panic sold on that breakdown is just left watching it go up without them. And even worse, any new short sellers who thought this was the start of a downtrend, they're now completely trapped and their own stop losses just become more fuel for the fire on the way up.
And what's so wild is that this exact same game works in reverse. So let's say the price now runs up to a really clear resistance level. The institution needs to sell its huge position and take profits. But who are they going to sell 1 million shares to? Well, they engineer a fake breakout above that resistance. This triggers a massive wave of FOMO, the fear of missing out, in all the retail traders who see the price rocketing and rush in to buy. And all those buy orders? That's the exact liquidity the institution needs to unload their shares and walk away with a huge profit.
Okay, so knowing all of this, how do you stop being the liquidity? How can you actually defend your portfolio from these engineered moves? Well, it really comes down to overcoming two very, very powerful psychological traps that we all fall into. All right, here are 2 simple rules that can help you survive the hunt. Rule number 1, don't just panic sell a breakdown, analyze it. The next time you see a sharp, high-volume dip below a key support level, especially in a stock that's fundamentally strong, just take a breath. Ask yourself, is this a real collapse or is this a quick, violent move designed to grab liquidity? See, a real trend change usually has some follow-through. A liquidity grab, it often reverses just as fast as it dropped. And rule number 2, don't FOMO buy a breakout, question it. A sudden spike through resistance, particularly after a stock has already run up a lot, is a classic setup for institutions to sell. Instead of chasing that price, just wait. See if the price can actually hold that new level. Remember, smart money often uses our FOMO as their exit sign.
When you think about it this way, it completely reframes the entire game, doesn't it? Once you really get this concept, you stop being just a passive participant who's, feeding liquidity to the big players. Instead, you can become a patient observer, someone who waits for these manufactured moves to happen because they can actually present much better opportunities.
And really, that's the ultimate takeaway here. The crucial question you should ask yourself is no longer just, what will the market do next? But instead, where is the liquidity? By shifting your focus to that one question, you start to analyze the market like an institution. You start seeing the traps before they're even sprung. And believe me, that can make all the difference in the world.
So the real secret isn't earning more, it's flipping one simple habit. Subscribe if you want to start keeping more of what you earn.